All right. Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we have a great topic. We're going to be talking about how to structure a HELOC combo loan. So we will go ahead and get into it. So I'll let Jose uh, get it going here. Jose, let's talk about how to structure HELOC combos.
All right. Good evening, everybody. Sorry about the delay. I had a little technical difficulty there with my PowerPoint. Um, so this is a very good time to be thinking outside the box with all of our different options here, ways to get creative, to get the deals. The HELOC combo loan is definitely one of those options, especially if you are in Florida, originating Florida loans specifically because of the condos, right? Issues with condos. But I'm not going to spill the beans early. So let's get into how to structure a HELOC combo loan. I got some good tips and tricks for you here. So, what exactly is a HELOC combo, right? Well, we know what a HELOC is. A HELOC is a home equity line of credit. It is an open ended mortgage. It can be a variable or fixed rate that does not have a fixed amortization table, where the interest expense is based on the current balance. In a HELOC, you pay interest only on what you owe, which is one of the things that makes HELOCs very attractive for the borrower that is looking to pay it off on an accelerated repayment plans. I'll tell you who the HELOC is not for, and then break it down a little bit more on the benefits. It's not for somebody that really can't afford to make those extra payments to get the full benefit of the HELOC. If it's somebody that's just looking to service the interest only payment for the time that it is an interest only payment, that's fine as long as that's part of their business plan that they have for the property, right? But if they view this is their 30-year loan, keep in mind that HELOCs, after the initial draw period, typically it's 10 years, but now we're getting something very popular with HELOCs with a 3-year draw period. After the draw period is over in a HELOC, it then becomes a fully amortizing loan based on whatever years are left. So if it had a 10-year draw period, you still have that HELOC. After 10 years, it now on year 11 converts to a 20-year fully amortizing loan, which you would want to probably refinance out of that loan, combine or maybe get another HELOC or whatever you can do. But keep in mind that that loan that you may have been paying only interest on all these years at a variable rate in some cases now becomes a fully amortizing loan. If it's a 3-year draw, then it becomes a fully amortizing 27-year loan at the end of year three. So keep in mind how that works, because what we really like the view the HELOCs for is for borrowers that can get on an accelerated payment plan, either monthly or maybe biweekly. There's a lot of uh, videos out there that can show you how to save money with a HELOC by accelerating the payment, especially on the biweekly, because you're paying that part 2 weeks earlier, so you're not going to get charged on 2 weeks of interest, and you end up also making 26 payments or in the year, right? So you end up making a few more payments and then end up saving money on the interest expense. So keep that in mind when you're explaining the HELOC combos to your buyers or borrowers. The HELOC now a HELOC in general. Now when it's a combo, obviously, but a HELOC in general can be in second position or in first position. The most common use of the HELOC is when it's in second position, especially for the HELOC combo. You'd have your existing mortgage, or actually, this would be a purchase typically if it's a combo, where the first mortgage, whatever the main mortgage, let's say typically it's going to be a conventional mortgage, is going to be in first position, and then the HELOC is going to be in second position. So theoretically, it is possible to combine the HELOC with an FHA loan, but it really is not much motivation to do so because of the loan limits. I mean, because it always MI, excuse me, in an FHA loan. And if you're trying to get around the loan limit, like trying to get that property, and the FHA loan limit is let's say $500,000 for an area, and your property is more, you can always combine it with a HELOC if you're not at the maximum LTV for an FHA loan, which is 96.5%. But I'm going to cover a little bit more about that in one of the slides coming up. So, first example here, you can use the HELOC combo, as I like to call it, as an MI buster, mortgage insurance buster, to eliminate private mortgage insurance. Now, how do you do that? Well, you're going to combine the HELOC with a conventional loan, right? Because they're the only ones that you can eliminate the mortgage insurance at 80% or below LTV, right? Wouldn't be possible, like I was just mentioning, in an FHA loan, because FHA loans are always going to have the mortgage insurance regardless. This also happens to be a great solution for lower credit score borrowers, where the PMI is much more expensive. Like, you have that borrower that maybe a 640 or 650. Now, keep in mind, you have to look at the FICO score requirements for the HELOC. I think we have options out there that'll go up to 90% with a 680 or above credit score. But a 680 credit score may have a really high cost of mortgage insurance. So you could combine that borrower with a HELOC up to a 90% CLTV, for example, give 10% down, save a little money there on the MI. Now, I did mention this as I was talking about on the previous slides in HELOCs, where then if you do have any of these structures where you're combining with a HELOC, one of the goals is to pay the HELOC off quicker, to build equity faster. And one of the ways to do this is with biweekly payments, for example. Another common one is to reduce the down payment on limited review non-warrantable condos. That's what I was alluding to when I was talking about Florida, right? So what is a non-warrantable condo? A non-warrantable condo is a condo that is not Fannie Mae approved due to any of the following reasons. Now, these aren't the only reasons that make a condo non-warrantable, but these are the main ones that we resolve when we are using the limited review option that Fannie Mae has for condos. So you would be solving insufficient reserves. You would be also solving the issue that could be faced by a high percentage of monthly assessment delinquencies, or a high renter to owner occupant ratio. The main one here really is the reserves. That's the one that you hear the most. The usual number is 10%. For Fannie Mae, it's 10%. So if the building doesn't have at least 10% of the annual budget assessment in reserves in a separate segregated reserve account, then it doesn't qualify for low down payment financing, like 3% or 5%. At that point, depending where you are, then you're going to have to give a large down payment. So, because I was mentioning, in the limited review condo, the association financials are not reviewed, but where you get the most benefit for that is in Florida, because in Florida, the maximum LTV for a limited review condo for a primary residence or second home is 75%. And for an investment property is 70%, which means borrower has to come in with either 25% for a primary second home or 30% for an investment. That's a lot of money. The rest of the U.S., it's 10%, the LTV max, when it's a limited review for the primary and second homes. Now, In Florida, especially, this is very popular, right? Because 10% is not such a big deal for a primary or second home, but 25% is. And even then, what if you want to give less down payment, right? So, what you do here in Florida is you are allowed to go up to a 90% CLTV on these Fannie Mae loans when there is a condo involved. So that is perfect for the combo loan because then in Florida you can go 75% on the first mortgage, 15% on the HELOC, and 10% on the down payment, and an added benefit of no mortgage insurance. So not only do you get to save money there on your down payment, but you also get to save MI, and then you're going to get on the accelerated repayment plan and pay that 15% HELOC down and only stay with the first mortgage. Now, this is one where we used the HELOC combo a lot in the past. In the beginning of the pandemic, when people were searching for money, we used it to give a lot of people cash out above and beyond the cash out LTV limits. Right now, why that's really important because if you do a rate and term refi, for example, you can do a rate and term refi up to whatever is the maximum LTV, let's say for a purchase loan, right? But a cash out, you can only do it up to 80% LTV. And you're also having the issue there where, you're going to have usually a higher loan level price adjustment for it being a cash out. Uh, but there's a number of things that are going on here when you're doing the rate and term refinance and adding a cash out. For example, you can use that HELOC, and this is something that a lot of people don't realize, right? Let's say you have the loan where your borrower is a little short, right, on income, right? You got to pay some credit cards down, or maybe pay a car down or off, right? You got to bring it down to whatever balance for the car for the months, so that it's not considered anymore in the installment loan, or just pay it down totally to qualify. But the borrower doesn't have an extra $7,000 or an extra $10,000 or whatever it is that they need now. Keep in mind the HELOCs do have minimum balances also. Usually, I think it's like $25,000. But in this scenario, and I've used this in the past, use the HELOC to pay a car off and to pay some credit cards to zero, save $700 or $800 or $900 a month in monthly payment, and the HELOC maybe is only a $200 a month payment. So now we're a $700 swing in our favor, and the borrower now qualifies. Now, keep in mind, again, CLTV comes into play, LTV comes into play for the property as well. So you really got to juggle things around. This one is a lot easier when it's a refi to do this than when it's a purchase, but we've actually used this on a purchase to help the borrower pay down balances and qualify. And also, you're getting cash out when you're paying those accounts off. It's already considered a cash out. So now you're using the cash out portion, right, is from the HELOC and not from the first mortgage. So in essence, you're doing your debt consolidation first mortgage, but that's being used just to pay down, just to refinance the first, and you're actually consolidating with the HELOC, and then being able to qualify all in one shot, right? Now, put your mind around that, how you can get that to work, because a lot of times we're thinking, okay, we're going to pay down some balances, and then you run out of LTV to pay down balances because either you maxed out the cash out at 80%, you got nothing left. Well, remember, the CLTV on these is usually 95% on Fannie Mae on these usually. So then, you can do that rate and term up to wherever you need to go to pay off that balance on the first, and then help the borrower qualify by paying down and consolidating and everything else that they want to do with the HELOC. So, a great tool there. And our last option here, pretty cool, is now in some of your states out there where you have higher loan limits, not so much of an issue. If your higher loan limits follow your higher property prices. But in some markets, like for example, the South Florida market that has pretty high home prices, but is not considered a high balance area, like Los Angeles County, for example, it really is an issue for buyers when they're trying to get in with only 5% down, right? That's the key. They want to do only 5% down, but you have loan limits of 725, 726, I think is the loan limit down here. So what do? Well, this is the perfect example. You get that $1 million property with only 5% down, right? $50,000. You have your first loan of $725,000 or whatever the limit may be in that area, max it out. And then you get your HELOC for the difference. And then obviously the accelerated repayment plan would be the goal here with this. But remember, now we do have something which is pretty cool now, which allows you to hedge that interest rate risk, is that we do have fixed rate HELOC. So before, the concern with some borrowers was that the HELOC was going to be a variable rate. It may be good now, but what's going to happen a year or two down the road? Well, we have variable rate HELOCs as well as fixed rate HELOCs, both with the same benefit of pay only on what you owe. So if you do embark on that accelerated repayment plan, then you will be able to reap the benefits of buying that jumbo property with only 5% down. So, uh, quite a few outside the box solutions here that you may not have considered with HELOCs. Everybody thinks of a HELOC as just an add as a product to get on its own. I want to get a second mortgage. I don't want to touch my first. But now you're seeing that the HELOC is also a way to get more money, to get a higher LTV, which is another thing is with the HELOC, depending on your loan options. Remember, if you're limited at 75% or whatever it may be, like with the condo, limited review condo, this allows you to reduce your down payment. So it's all about reducing the down payment amount or not having to treat it like a cash out to get higher LTV with lower loan level price adjustments. So don't forget your HELOCs when structuring all your different loan combinations, especially when you're trying to have the borrower pay off accounts to qualify and you ran out of LTV. You guys probably didn't think about that one. So hopefully that'll help you put some loans together.
All right, great. Thank you, Jose. I do not see any questions actually, but this definitely great tools for us to have there. Appreciate everybody tuning in. Remember that we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we go through a training on a loan officer topic here. So we appreciate everybody tuning in, and we will see you tomorrow night at 7 p.m. Eastern for the next episode